Investor Cathie Wood has risen to prominence in the past few years, as her bold bets on technology companies have garnered a ton of attention and, to the surprise of many skeptics, have paid off pretty well so far. Her bold calls, such as predicting Tesla to reach $3,000 a share by 2025 and Bitcoin being able to reach $500,000, have gotten her a fair share of critics, but also fans who passionately support her and believe in her vision of the technological future. However, recently, critics and skeptics have started to significantly put their money where their mouth is. Short sellers, or people betting on the decline in price of her flagship ARK Innovation Fund, have ramped up bets against the fund in the belief that her investment strategy may be showing signs of faltering and that many of the stocks that she owns are significantly overvalued. Make sure to stick around to the end of this video, where we will talk about the hidden reason that isn't being talked about why hedge funds are betting against Cathie Wood. As of August 3rd, a record 12% of the ARK exchange traded fund shares are being shorted by investors betting on a decline, a bet worth more than $2.7 billion. To truly understand these bets against the fund, you first have to understand just who Cathie Wood is, her investment strategy, and why that strategy is so polarizing. Cathie Wood is the founder, CEO, and CIO of ARK Invest, an investment management firm. Wood had a pretty successful career on Wall Street before leaving her job at AllianceBernstein to find her own investment management firm. In 2014, after more than a decade at the firm, and after her idea for actively managed exchange-traded funds based on disruptive innovation was deemed too risky by AllianceBernstein, Wood left the company and founded ARK Invest. ARK's first 4 ETF funds were seeded with capital from Bill Huang of Archegos Capital Management, the same hedge fund who went bust after heavily leveraged bets on stocks went against the fund. Wood is known for making bold predictions. She received considerable media attention in February 2018 after she stated on CNBC that she believed Tesla stock could reach a price of $4,000 in 5 years, a 1,100% increase from its price at the time, and reiterated the claim in May 2019 after its price had dropped 29%. While Wood's statement was widely ridiculed at the time, Tesla's price reached her target on a split-adjusted basis 2 years early in January 2021. In November 2020, she stated she believed Bitcoin could reach a price of $500,000. The ARK Innovation ETF is unique for most prominent funds. It is unique because the fund is structured as an ETF, meaning the fund is listed on an exchange and the average investor can buy shares in the fund just like a stock. Given this fact, the fund's recent performance, and Cathie Wood's loyal following among individual investors, it should come as no surprise that many of the investors in the fund are retail investors. Despite the frequent criticism about its strategy, the fund has posted some pretty eye-popping investment returns. The fund has posted a 5-year annual return of 44%, a 3-year return of 41%, and a 1-year return of 47%. This is especially impressive when you consider the S&P 500 has had an average annual return of around 15% over the same 5-year time frame, meaning Cathie Wood's ARK fund has more than tripled the return of the S&P 500 over a 5-year period. Some will point to these returns as an example of the fund being extremely overvalued. So let's take a look at the fund's holdings, and you can be the judge of that. Cathie Wood really started to gather a ton of publicity from her Tesla call. No matter what you think about her, you have to respect the courage that it took to go on national television and publicly make the controversial claim about the future stock price performance of Tesla. Despite already being considered overvalued by many analysts when comparing Tesla to traditional automakers, Wood argued that the company had more than a 1,000% upside from its current stock price. With Cathie Wood's conviction in the long-term success of Tesla and its founder, Elon Musk, it should come as no surprise that the largest position in the ARK Innovation ETF is Tesla, at just over 10% of the portfolio. This is the largest position in the fund by far, more than double the size of the second largest position. I'm sure most of you are familiar with Tesla, but for those of you who aren't, Tesla designs, develops, manufactures, and markets high-performance, technologically advanced electric cars and solar energy storage products. Tesla sells more than 5 fully electric cars, including the Model S sedan and the Model X SUV. Wood believes strongly in the value of the company's data and the $7 trillion opportunity in the autonomous ride-hailing market, of which the automaker could grab a significant chunk. Wood said, "Tesla is in the pole position in the United States to become the autonomous taxi network." She makes the argument that Tesla should be valued not as a car manufacturing company, but as a disruptive technology company. Before we go on with the rest of Cathie Wood's portfolio, I just want to take a minute and thank you for watching this video. Subscribe to the channel because this community is over 50,000 people strong and continues to get bigger and better every day. It would be even better with you as a part of it. Now back to the video. The next largest position in their portfolio is the healthcare services company Teladoc, representing 5.7% of the total portfolio. Teladoc diagnoses, recommends treatment, and prescribes medication for routine medical issues through phone and video consultations. This company's goal is to disrupt the healthcare industry, which in America is known for being expensive and rapidly increasing in cost. Teladoc aims to reduce the cost of some healthcare services by having them be done remotely over video and text, reducing the need for in-person doctor visits. The third largest position is Roku, representing 5.6% of the portfolio and is the biggest positive contributor this year to the fund's investment performance. For those of you that aren't aware, Roku is a consumer electronics company. The company manufactures a device that can stream shows, movies, and music directly to a TV. The streaming device gives the user access to a wide range of TV channels and streaming channels. This stock has had quite the run over the last 16 months, up from a low of around $70 a share in March 2020 to around $400 a share currently. The stock price was even approaching $500 a share last month in July. The next largest position in the fund is Zoom at 4.8% of the portfolio. This company has been the ultimate beneficiary of working from home and learning from home. I knew it was a sizable company in terms of market cap, but didn't know until I started doing research for this video that Zoom's market cap is over $110 billion. The stock price was around $100 in early 2020, but has increased nearly 4 times to around $400 a share currently. This is down from the more than $550 a share it was trading at in late 2020. Cathie Wood is a big believer of this company and thinks remote working and remote learning are here to stay, and that Zoom will be a huge winner. The fifth largest position in Cathie Wood's fund is Square. If your neighborhood bakery or coffee shop now accepts credit cards as well as cash, you might have Square to thank for that convenience. Square provides hardware, a square-shaped card reader, and software to merchants and other service providers that enable them to accept credit card payments. Square makes money by charging merchants a service fee for processing the transaction, with its standard fee being around 2.75%. Square also owns Cash App, the popular money transfer app and rival to Venmo. The stock has had quite the run over the past 16 months or so. The stock was trading around $40 a share in March of 2020, but is now trading around an all-time high of nearly $300 a share. Maybe you are seeing a common theme in the ARK Innovation ETF. The companies in the portfolio are very much focused on technology and disrupting traditional industries. Whether it is Tesla disrupting traditional internal combustion engine auto manufacturers, Teladoc disrupting the healthcare system, or Square disrupting the way consumers pay for goods and services at small businesses, disruption is the overarching theme in Cathie Wood's portfolio. So this raises an important question. Why exactly has Cathie Wood's portfolio and investment strategy gotten so much criticism despite its strong return performance? The answer to this is that many critics of Cathie Wood think the companies in her portfolio are overvalued based on their earnings. To see the point these critics are making, let's take a look at the price-to-earnings ratio, commonly referred to as a PE ratio, of some of the companies in the ARK Innovation portfolio. Most importantly, let's compare that to the S&P 500, which is an index of the 500 largest publicly traded companies in America. For this example, the PE ratio is being calculated by taking the current price and dividing it by the estimate for next year's earnings of the company. All else being equal, and I emphasize all else being equal, the higher a company's PE ratio, the more expensive a stock is. The inverse is also true, with the lower the PE ratio, the more cheap a stock is. The S&P 500 is currently trading at a PE ratio of around 22. This compares to a PE of 137 for Tesla, 342 for Roku, 128 for Zoom, and of 155 for Square. The second largest holding in the ARK Innovation Fund, Teladoc, doesn't even have a PE ratio because its earnings are negative. I want to make something clear. Just because a company has a high PE multiple doesn't necessarily mean a company is overvalued. The other variable that needs to be considered is how fast and for how long that company is going to be able to grow those earnings. A company that is growing earnings quickly and that will be able to for a long time could very much justify a high PE ratio. The main point of debate between Cathie Wood and her critics revolves around the ability of those companies to substantially grow earnings at a high rate for an extended period of time. If the companies in the ARK Innovation ETF are able to grow earnings at a 20% annual rate for the next 20 years, many of the high stock valuations will turn out to be justified. However, that is a big if, and only time will tell. So this brings us to the big question. Why exactly are hedge funds shorting the ARK Innovation ETF? There are two main reasons for this. The first is obvious. They are shorting it because they think it is overvalued and they can make money when the stocks in their portfolio come down to more reasonable levels. This is pretty straightforward. The second reason, however, is not so obvious. To understand the second reason, you have to understand the investment strategy for most hedge funds. The general investment strategy for a hedge fund is to be long a certain number of companies, meaning betting on the prices for those companies to increase. On the other side, hedge funds also need to be short a certain number of names, meaning betting these companies' stock price will decrease. Some hedge funds are using her fund to be short technology stocks without exposing themselves to one particular stock. Since her portfolio has a large number of stocks in it, investors who are short the fund aren't overly exposed to one name. Since some of the stocks that a hedge fund may want to short are extremely volatile, meaning they move around in price dramatically, it is extremely risky to go short a highly volatile stock because you could lose a substantial amount of money if the stock price increases sharply. Since Cathie Wood's portfolio consists of many stocks, it is overall less volatile to short than any one stock within her portfolio. Therefore, it is less risky to short. Make sure to subscribe to the Investor Center because it is my goal to make you a better, more informed investor. And if you want to keep up with my personal investments and hear more about my thoughts on the market, download the public app using the link in my description. Using this link, you will receive a free slice of stock of your choosing with a deposit of as little as $1. Talk to you soon.